Hey everyone, welcome to the subject income taxation. But before delving into or before getting into the details about what income taxation is all about, we will be talking first the overview of taxation. And this is the chapter 1, Introduction to Taxation. And by the way, we're using the book Income Taxation Laws, Principles and Applications by Mr. Rex B. Bangawan, CPA MBA. Okay, so we're going to start with the definition of taxation. So, what is taxation? Taxation may be defined in three ways: one, as a state power; two, as a process; and three, as a mode of cost distribution. So, as a state power, this means that taxation is an inherent power of the state. So even if the Constitution does not expressly mention the said power, the state can still exercise the power to tax to its subjects for public purpose. As a process, taxation is a process of demanding and collecting contributions, which is in the form of tax from its subjects for public purpose. And lastly, as a mode of cost distribution. So as we all know, the state or the government spends for the benefit of the public. And because of this, the state distributes its cost by imposing the taxes. Now, why does the state or the government collect tax? So as you guys observed, the government provides a lot of services for the public, just like the defense, the public order and safety, the health, your education, the social protection, and a lot more. However, the government cannot provide any of the services without money, without funds. And the fact that the government needs funds is the theory of taxation. The basis of taxation can be illustrated in this manner. So we have here the government. So the government provides public services to the people. And then in return, the people will going to provide the funds by paying taxes to the government. So this is now the basis of taxation. So some people might be thinking why they have to pay taxes when they don't receive any benefits from the government. Well, it's not true. Even though we don't actually avail the benefit from the government, that doesn't mean that we don't receive any benefit at all. Come to think about the roads and the bridges that we pass by, the peace and order. So we all benefited that. And those are services coming from the government. So in other words, we all receive benefits from the government. It might be directly or indirectly. So let's now move on to the theories of cost allocation. So the government, through taxation, allocated the cost of providing services to the public in consideration of the following theories. One is the benefit received theory, and then the second one is the ability to pay theory. So under the benefit theory or benefit received theory, if one receives more benefits from the government, that would mean he has to pay more taxes. While under the ability to pay theory, taxation considers the taxpayer's ability to pay. So taxpayers are required to contribute only based on their capacity. So if they have less, that means they should pay less amount of tax, even if, let's say, they receive more benefits. If they have more, then they have to pay more tax, though they receive less benefits from the government. Again, what matters here is the capacity of the taxpayer to pay. Now, the Lifeblood Doctrine. So this simply means that taxes are very, very important for the government to continually exist. So without taxes, the government will be paralyzed. Here's now the implications of the Lifeblood Doctrine in taxation. Number one, tax is imposed even in the absence of a constitutional grant. So this talks about taxation as an inherent power. Number two, claims for tax exemption are construed against taxpayer. So tax exemptions is somewhat unfavorable in the part of the government. That is why it is construed in favor to the government and not to the taxpayers. Number three, the government reserves the right to choose the objects of the taxation. Number four, the courts are not allowed to interfere with the collection of taxes. Number five, in income taxation, letter A, income received in advance is taxable upon receipt. So income received in advance is taxable as soon as this income is received. Letter B. Deduction for capital expenditures and prepayments is not allowed as it effectively defers the collection of income tax. So this is because if you allow capital expenditures and prepaid expenses to be deducted from income, it will result to a lesser income. And to taxation, lesser income means lesser tax base. And lesser tax base will result to a lesser tax, and that is unfavorable to the government. Letter C, a lower amount of deduction is preferred when claimable expense is subject to limit. So this again is in favor to the government. Lower deduction will result to a higher income tax base and consequently higher tax will be collected. Letter D, a higher tax base is preferred when the tax object has multiple tax bases. So same with letter C, this is in favor to the government. Higher tax base will allow the government to collect higher amount of tax. Now we'll talk about the inherent powers of the state. So as the title suggests, inherent powers. So this basically are the powers that coexist with the birth of the government. So though the Constitution of the Philippines does not expressly grant these powers, but the fact that these are inherent, the government can still exercise all these powers. So these are the inherent powers of the state. 1, taxation power. 2, police power. And 3, eminent domain. The taxation power is the power of the state to enforce proportional contribution in a form of tax from its subject in order to sustain itself in providing services to the public. The police power, on the other hand, is the power of the state to enact laws in order to protect the well-being of the people. And then lastly, the eminent domain. So this is the power of the state to take private properties and use them for the public after paying equitable compensation. The scope of the taxation power is comprehensive, plenary, unlimited, and supreme. However, it still have limitations, and these are the inherent limitations and constitutional limitations. And the following are the inherent limitations of the state. We have number 1, territoriality of taxation. Number 2, international committee. 3, public purpose. 4, exemption of the government. And 5, non-delegation of the taxing power. Okay, so we will be discussing one by one these inherent limitations, and we'll start with the territoriality of taxation. So the government provides services within its boundaries only, and that means that the government can only collect taxes from the people within its boundaries or territorial jurisdiction. So the state therefore cannot impose tax to subjects abroad. The territoriality of taxation also has the following exceptions. Number 1, in income taxation, resident citizens or Filipinos residing in the Philippines and domestic corporations or corporations that are organized under the Philippine laws are taxable on income derived within and outside the Philippines. Number 2, in transfer taxation, residents or citizens such as resident citizens, non-resident citizens, and resident aliens, they are taxable on transfer properties located within and outside the Philippines. By the way, when we say resident citizen, this refers to a Filipino residing in the Philippines. And then when we say non-resident citizen, this refers generally to Filipino living abroad. When we say resident alien, this refers to a person residing in the Philippines but is not a citizen. And then when we say non-resident alien, this refers to a person who is not residing in the Philippines and is not a citizen thereof. We will be discussing more of these types of taxpayers in a different chapter, but for now, we will continue discussing the inherent limitations of taxation. By the way, since we are already talking about taxpayers, I would like to mention the twofold obligations of the taxpayers, and these are number 1, filing of returns and payment of taxes, and then number 2, withholding of taxes on expenses and its remittance to the government. Moving on to the second inherent limitation of taxation, and that is international comity or mutual reciprocity. So that simply means that all nations or all countries are equal. No country is powerful than the other. Therefore, governments do not tax the income and properties of other governments, and governments give primacy to their treaty obligations over their own domestic tax laws. And so with this, the embassies or consular offices of foreign governments in the Philippines, including the international organizations and their non-Filipino staff, are not subject to income taxes or property taxes. And then under NIRC or National Internal Revenue Code, income of foreign government and foreign government-owned and controlled corporations are not subject to income tax. The third inherent limitation of taxation is public purpose. So this just means that the tax must be for the public purpose and it should not be used for any private interest. Then another limitation or inherent limitation of taxation is exemption of the government. So the government properties and income from essential public. So I like to emphasize the word public. So any government properties and income from essential public functions are not subject to taxation. But the income of the government from the properties and activities conducted for profit, including income from GOCC or government owned and controlled corporations, is subject to tax. The last inherent limitation of taxation is the non-delegation of the taxing power. So, the legislative taxing power is vested exclusively in the Congress and it can never be delegated. However, there are exemptions of this non-delegation rule. First one is under the Constitution, local government units are allowed to exercise power to tax to enable them to exercise their fiscal autonomy. Second, under the Tariff and the Customs Code, the President is empowered to fix the amounts of tariffs to be flexible to trade conditions. And then number three, other cases that require expedient and effective administration and implementation of assessment and collection of taxes. Let's now move on to the constitutional limitations of taxation. We have number one, due process of law. Number two, equal protection of law. Three, a uniformity rule in taxation. Four, progressive system of taxation. Five, non-imprisonment for non-payment of debt or poll tax. Six, non-impairment of obligation and contract. Seven, free worship rule. 8. Exemption of religious or charitable entities, non-profit cemeteries, churches, and mosques from property taxes. 9. Non-appropriation of public funds or property for the benefit of any church, sect, or system of religion. 10. Exemption from taxes of the revenues and assets of non-profit, non-stock educational institutions. 11. Concurrence of a majority of all members of Congress for the passage of law granting tax exemption. 12. Non-diversification of tax collections. 13. Non-delegation of the power of taxation. 14. Non-impairment of the jurisdiction of the Supreme Court to review tax cases. 15. The requirement that appropriations, revenue, or tariff bills shall originate exclusively in the House of Representatives. And lastly, number 16. The delegation of taxing power to local government units. Okay, so we will be discussing all these constitutional limitations one by one, and we're going to start with the first one, the observance of due process of law. So under this constitutional limitation, no one should be deprived of his life, liberty, or property without due process of law. The tax law should neither be harsh nor oppressive. So under the NIRC, the assessment shall be made within 3 years from the due date of filing of the return or from the date of actual filing, whichever is later. And then the collection shall be made within 5 years from the date of the assessment. Next, we have equal protection of law. So this means that taxpayers should be treated equally both in terms of rights conferred and obligations imposed. But this only applies to taxpayers under the same circumstances and conditions. So if, for example, a balot seller is exempt from tax and then the Penoy seller is subjected to tax, so this is a violation to the equal protection of law. Balot and Penoy are same goods. So therefore, both sellers of balot and Penoy should be treated equally. So if the balot seller is exempt from tax, then the seller of Penoy must also be exempted from tax. Moving on to the third constitutional limitation, and that is the uniformity rule in taxation. So the rule of taxation shall be uniform and equitable. Taxpayers are of different classes, and each class is taxed differently, but the taxpayers that are of the same class, they must be taxed the same. Then we also have progressive system of taxation. So under the progressive system, tax rates increase as the tax base increase. So this is consistent to the ability to pay theory of taxation. So if you have more, you will be taxed more. Another constitutional limitation is the non-imprisonment for non-payment of debt or poll tax. Okay, so we will start with the non-imprisonment for non-payment of debt first. So no one will be imprisoned because of debt unless that debt is acquired in bad faith, like there is a fraud involved. Because the moment the debt is acquired in bad faith, that constitutes estafa, and that is a crime punishable by imprisonment. Now we'll go to the tax part. So we have here a question. Is non-payment of tax equivalent to non-payment of debt? So I want you to take note that tax and debt have different sources. The tax arises from law and is a demand of sovereignty of the government, while the debt arises from private contracts. So non-payment of tax will compromise public interest since tax is used to spend for public services, while the non-payment of debt will compromise the private interest only. The non-payment actually is similar to a crime that is punishable by imprisonment. Again, the non-payment of tax is actually similar to a crime that is punishable by imprisonment. However, there is an exemption to that as provided by the Constitution, and that is the poll tax. So poll tax is also known as personal tax or community tax or residency tax. If we're going to pay this poll tax, we're given a certificate of community tax or what we often called as cedula. So the poll tax, by the way, has two components, the basic community tax and the additional community tax. So you can see it in your cedula. The non-imprisonment for non-payment of poll tax as provided in the Constitution applies only to the basic community tax. The non-payment of additional community tax is a form of a tax evasion, and that is punishable by imprisonment. Another constitutional limitation of taxation is the non-impairment of obligation and contract. So the government should not set aside its obligation from contracts by the exercise of its taxation power. So the exemptions granted under contract should be honored and should not be cancelled by a unilateral government action. Next is the free worship rule. So here in the Philippines, we have freedom of religion, and the exercise of whatever religion is not subject to taxation. So with that, the properties and revenues of religious institutions like the offerings are not subject to tax. But the income from the properties or activities of religious institutions that are commercial or business in nature is subject to tax. Another constitutional limitations of the taxation power is the exemption of religious, charitable, or educational entities, non-profit cemeteries, churches, and mosques, lands, buildings, and improvements from property tax. So take note that this exemption from property tax applies only for properties that are actually directly and exclusively or primarily used for charitable, religious, and educational purposes. Another constitutional limitation is the non-appropriation of public funds or property for the benefit of any church, sect, or system of religion. So this is because there is a separation between religion and state or the government. So the government is not allowed to give projects to appropriate public funds or any property in support of any religious institution. Another constitutional limitation is the exemption from taxes of the revenues and assets of non-profit, non-stock educational institutions, including grants, endowments, donations, or contributions for educational purposes. This is because the Constitution recognizes the importance of education and the nation building. The said exemption only applies to the revenues and assets that are, take note of these keywords, actually, directly, and exclusively devoted for educational purposes. The NIRC also exempts government educational institutions from income tax, while the private educational institutions are subject to a minimal 10% income tax. Another constitutional limitation of the taxation power is the concurrence of a majority of all members of Congress for the passage of a law granting tax exemption. So this simply means that absolute majority or majority of all members of the Congress is required in order to approve an exemption law. And then another one is the non-diversification of tax collections. So this means that the tax collected should only be used for public purposes and should no way be used for private purposes. Next one is the non-delegation of the power of taxation. So this is in accordance to the principle of check and balance in a republican country, requiring that the taxation power as part of lawmaking be vested exclusively in the Congress. But the delegation may be made with regards to the effective administration and implementation of assessment and collection of taxes. That is why we have the BIR, or the Bureau of Internal Revenue, and DOF, or Department of Finance. But take note that their functions are merely intended to interpret or clarify the proper application of the law. They are not allowed to introduce new legislations. Next, we have the non-impairment of the jurisdiction of the Supreme Court to review tax cases. So this means that all cases involving tax can only be raised to and finally decided by the Supreme Court of the Philippines, even though we have this special court known as the Court of Tax Appeals. And then moving on to the next constitutional limitation of the taxation power, and that is appropriations, revenue, or tariff bills shall originate exclusively in the House of Representatives, but the Senate may propose or concur with the amendments. So any law that may add income to the national treasury and allow spending must originate from the House of Representatives, while the Senate may concur with the amendments. And finally, we are down to the last constitutional limitation of taxation, and that is each local government unit shall exercise the power to create its own source of revenue and shall have a just share in the national taxes. So this is a constitutional recognition of the local autonomy of the local governments and an express delegation of the taxing power. Let us now move on to the stages of the exercise of taxation power. So there are two stages. One is the levy or imposition, and the number two, assessment and collection. The levy or imposition is the process of enactment of a tax law by the Congress. And then, by the way, the Congress has two bodies, the House of Representatives and then the Senate. So as mandated by the Constitution, the tax bills or the tax laws must originate from the House of Representatives. However, these two bodies may have their own versions of a proposed law, which is approved by both of them. But tax bills or tax laws cannot originate exclusively from the Senate. The second stage of the exercise of taxation power is the assessment and collection. So the tax law is implemented by the administrative branch of the government. The implementation includes assessment or determining how much tax the taxpayer shall pay and the eventual collection of the said tax. So this stage is referred to as incidence of taxation or administrative act of taxation. Now moving on to the situs of taxation. So situs refers to the place of taxation. In taxation, we have situs rules that guide us in determining whether the tax object is within or outside the tax jurisdiction of the taxing authority. And here's some of the situs rules. So number one, we have business tax situs. So businesses are subject to tax in the place where the business is conducted. Like for example, a taxpayer is involved in car dealership abroad and he also have a restaurant operation in the Philippines. So the restaurant business will be subject to the business tax in the Philippines because the restaurant is located in the Philippines. And then the car dealing business is exempt because the car dealership business is conducted abroad. Number two, income tax situs on services. So service fees are subject to tax where they are rendered. So for example, a foreign corporation leases or rents a residential space to a non-resident Filipino citizen abroad. So the rent income will be exempt from the Philippine taxation because the leasing service is rendered abroad. Number three, income tax situs on sale of goods. So the gain on sale is subject to tax in the place of sale. So for example, Juan is a non-resident OFW citizen in China. So while he was still in China, he agreed to sell his diamond necklace with a Chinese friend. And then in the contract of sale, they stipulated that the delivery of the item, which is the necklace, and then the payment will be made a week later in the Philippines. So the sale took effect as they both agreed. So the contract of sale is consensual, meaning the consent of the Chinese friend and Juan are both present. So therefore, the contract of sale is perfected by the meeting of the minds of the parties. So the perfection of the contract of sale happened in China. So the situs of taxation is in China. So therefore, the gain on sale of the necklace will be taxable abroad and it will be exempt in the Philippines. Number four, property tax situs. So properties are taxable in their location. So for example, an OFW has a residential lot in the Philippines. So that OFW will still pay the real property tax despite that he's not in the Philippines because his property is located here in the Philippines. Number five, personal tax situs. So persons are taxable in their place of residence. So for example, let's say Ahmed Lofty, who is Sudanese or he's from Sudan and then he's here in the Philippines because he's studying medicine. So Ahmed will pay personal tax in the Philippines even though he is an alien or he's a foreigner because he is residing in the Philippines. Okay, so we'll now proceed to the other fundamental doctrines in taxation. So we have number one, Martial Doctrine. And it says that the power to tax involves the power to destroy. So in this doctrine, the taxation power may also be used as an instrument of police power to discourage or prohibit undesirable activities or occupations. So like for example, the excise tax on cigarettes and liquors. So cigarettes and liquors right now is very expensive because of the tax added into the price. And this is a way of discouraging the people to use cigarettes and drink liquors, which are both harmful to health. The second one is the Holmes Doctrine, and it says that taxation power is not the power to destroy while the court sits. So here in this doctrine, the taxation power may be used to build or encourage beneficial activities or industries by the grant of tax incentives. So example of this include the creation of eco zones with tax holidays and provision of incentives like the omnibus investment code and the BMBE law or the Barangay Microbusiness Enterprise law. The third doctrine is the prospectivity of tax laws. So tax laws are generally prospective in operation. So this means that tax laws are applied prospectively, meaning it may operate effective from a particular date in the future. However, income tax laws may operate retrospectively, meaning it may operate effective from a particular date in the past if so intended by the Congress under certain justifiable conditions. The fourth one is non-compensation or set-off, and it says that taxes are not subject to automatic set-off or compensation. So tax is not a debt, and therefore it cannot be subjected to an automatic set-off or compensation. So the taxpayers cannot delay his tax payment to wait for his pending claim against the government. Another fundamental doctrine in taxation is the non-assignment of taxes. So this simply means that the tax obligations of Juan cannot be assigned or transferred to Pedro by contract. Number 6, imprescriptibility in taxation. So the government's right to collect taxes does not prescribe unless the law itself provides for such prescription. So this means that the right of the government to collect tax does not prescribe or does not expire even the passing of time unless the law itself provides for the prescription. Number 7 is the doctrine of estoppel. So under the doctrine of estoppel, the misrepresentation of Juan towards Pedro, who rely therein in good faith, will be held true and binding against Juan. However, the government is not subject to estoppel. So therefore, any misrepresentation made by any government employee does not bind the government or does not hold the government responsible. It's only the employee that will be held liable for that misrepresentation. Number 8 is the judicial non-interference. So generally, the court is not allowed to issue an order that says something must be done or must not be done against the government's pursuit to collect tax, as this will delay the collection of tax. So this is in connection to the Lifeblood Doctrine of Taxation. And lastly, number 9, strict construction of tax laws. So when the law clearly provides for taxation, taxation is the general rule unless there is a clear exemption. So when the language of the law is clear and categorical, so therefore there is no room for interpretation. There is only room for application. However, when taxation laws are vague, the doctrine of strict legal construction must be observed. So if there is any tax law that is indefinite or not clear, such tax law must be interpreted in favor to the taxpayers. Thus, a vague tax law means no tax law at all. On the other hand, if there is any tax laws on exemptions that is indefinite or not clear, it must be interpreted against the taxpayer. Therefore, a vague tax exemption law means no exemption law.